Hey guys, it's Chris Mincolla with the Mincolla Group over at West USA Realty, and I'm doing our housing weekly market update. Hope everybody's doing well. Um, well, we've got still got war in Iraq going on. Everybody suggests that it won't take that long. We'll kind of see how that goes, but right now, overall, the housing market across the country, we've got mortgage rates staying near 6% on the average. We have them lower here, which I'll talk about in a minute, much lower. Usually, wherever the average is across the country, our mortgage broker is going to be about 100 basis points or 1% or more or less, which basically comes down to pricing and what they're charging you. So, and whether or not they're shopping the right or even can shop around with different lenders. But rising oil prices and strong economic demand right now. So, I think that's going to be a short-lived thing. I think it has to do with the insurance that's dealing with a lot of the ships coming out of there. So President Trump just came out with a thing where he's going to basically say, well, the if London isn't going to insure the ships coming out of there, I'll insure it through the U.S. here. So we'll see how that all goes. I mean, with the capacity and everything that they've taken out already, I don't foresee this being a forever thing. So we'll see. I'm not an expert at that, but I can tell you about real estate. So the key reason that we're seeing mortgage rates stay within kind of that 6% across the country, goes below, goes above a little bit, is because of the mortgage spreads getting better. Fannie Mae buying those 200 billion in mortgage-backed securities were kind of that safeguard that we've been talking about to keep the 10-year treasury within line with mortgage rates. Usually there's about a 1.6 to 1.8% spread between the two. It's kind of, we call that the slow dance between the two of those, but you can kind of always see where rates are based on that 10-year treasury for the most part. So it hasn't broken above 4.15. Analysts, say that if it went above that, rates could go up a little bit more, but we'll see where we're at. So I'm going to share my screen here with you and get into the data because I got a lot of great news for you. So this here is the Zillow February market report points to spring rebound. This lines up with Altos Research and Housing Wire data. So, the great thing with the internet, AI, and a lot of this stuff now, where kind of we always talk about this, where the Fed lacks is we have real-time data on this stuff. So I put together a summary here for you if I can find it for you. There we go. And basically, typical U.S. home value is 361,000. Prices are up 0.1% month to month, 0.4% year over year. First monthly increase in 7 months. Okay, so you're going to see that everything's kind of heading in the right direction here. Inventory is at 1.12 million homes for sale. That's up 5% year over year. And remember, if we got more homes on the market, there's more choices for people to want to make that move. It also may stimulate some of that, keeping price levels at a moderate pace, where they're increasing, but not anything crazy so that we don't get out of control like we did in 2021. New listings, 283,000. Um, that's a negative 3% year over year for new listings. But we just had a surge right after this came out, which I'll talk about here in a second, plus 4.9% from January. Home sales at 239,000. So that's up 1.8% year over year, plus 13% from January. So that's a good marker. Zillow outlook spring market expected to improve slightly versus 2025. And that's basically what we're talking about. We're talking about getting 200 to 300,000, maybe 400,000 more sales than we had last year with the lower rates, and some other things that we'll talk about. Affordability Typically, monthly payment, 20% down, is at 1,738,000 at a typical monthly payment for 20 if you put 20% down, 7.7% lower than last year. So affordability slowly improving. We also have income. People's salaries has been going up a little bit at a little bit faster rate, and a lot of that has to do with the GDP going up. Mortgage demand, mortgage applications, plus 11% week over week. Now, this is huge, okay? Because this tells us where we're kind of heading the next 30 to 90 days. I really want to stress this mortgage demand. So mortgage applications, okay, plus 11% week over week. That tells us the next 30 to 90 days we've got more people out there getting qualified, pre-qualified for a home loan, whether they're first-time home buyer, already own a home, whatever the case may be. That's a great indicator that more people are jumping back into the market. Year refinance apps week over week are up 14% and plus 109% year over year, guys. Purchase apps are up 6% week over week. Okay. And lower rates last week helped push demand higher. So, again, this is across the country. We'll get into Phoenix here in just a second. Mortgage rates, 30-year fixed around 6.13% when this was taken. They're a little bit lower today, up slightly from 5.9% last week. Now, when this came out, they had the ADP report. I'll get into the BLS report in a second. And the reason why this is important is because the markets, the 10-year Treasury and the Fed, they look at inflation, but even more importantly, jobs. Okay. Think labor over inflation when it comes to the bond market and for the Fed messaging and what they're going to do with the Fed fund rate, which will indirectly affect mortgage rates typically, but usually the bond market already prices these things in ahead of the Fed. Okay. 63,000 new private jobs in February versus 48,000 expected. So from the ADP report, that's good news. We'll get into the BLS in a second. I know there may be some people out there that are like, yeah, but the BLS came out and it was different. Yeah, it was different. So we don't put as much stock in the ADP, but January revised down to 11,000 jobs, private jobs. These are private jobs. These are not some of the bigger markers that are taken. Okay. Job market described as stable and solid. Okay. I would beg to differ there a little bit, and I'll get into that. Construction jobs, according to ADP, was plus 19,000, positive economic indicator. Okay. But BLS came out with something different. So we'll just have to, we're just going by the data and what's being put out. I'll get into that in a minute. Unemployment around 4.3%, according to ADP. Again, we're going to see that was different in the jobs report that came out today. Strong jobs may give the Fed less reason to cut rates soon. Fed outlook, markets pricing 98% chance the Fed holds rates steady at the next meeting, which is probably, everybody's saying they're not going to lower the rate, but we'll have to see with these jobs reports what comes up, especially with revisions. Key takeaway data suggests 2026 housing activity should be slightly stronger than 2025, nothing crazy. And that's what Realtor.com has come up with, Fannie Mae, especially heading into spring market, despite rates staying around low 6%. Now, one thing I want to point out to you, the people who are kind of sitting on the sideline saying, rate's going to go lower, again, if you're buying a new home, you're going to get all the incentives in the world. They're offering rates, if you're doing a 3-2-1 buy down or 2-1 buy down, you can get rates starting at 1.9%. Okay. You can even negotiate those kind of things into a resale deal. Okay. So the thing to keep in mind though is, even Fannie Mae is projecting that rates are basically going to be around that 6%, up and down a little bit, but around 6% for the next couple of years. So if you're sitting on the sidelines waiting, I wouldn't wait. Now, here's the other thing. Again, you can get lower rates now just out of the box without even any negotiations, not even going to a new build, if you are working with a mortgage broker. So I'll show you that here shortly, but just want to make sure I really stress those points. And now we can get rid of this. I don't want to save that. So that was the Zillow report, lines up with Altos Research and Realtor.com, all that basically, and is great real-time data. So price cuts are on the rise. This is from Redfin. The share of homes relisted in January that were listed below their original list price. Okay, so we got 36%. The for the price they listed at are doing price reduction, 36%. Okay. Normally that number, realistically is gonna, for the greater Phoenix area, for instance, that isn't really much higher. We're usually going to see about a third of the homes have a price reduction in a normal balanced market. Usually that number in the greater Phoenix area is going to be right around 97.8%, on the average, historical average. So, if you delisted your home last year, it says after cutting the price from 550 to 525,000, don't try to relist it now at 550 is what they're saying from Redfin. So again, that's going to be different for every local market, every local subdivision also. Relistings are most common. People who tried to list their house didn't sell, okay, the first time around. Remember, interest rates are much lower now. We've seen that overall over the last year, mortgage application data is hovering right around 10, 11% year over year. So new people applying for home loans. And we can see the Phoenix area right here is hovering right around 4.25%. Okay. For relistings, people who are relisting their home for sale that didn't sell the first time around. Again, in a normal market, that number will be about 25 to 35% anyway. So a lot of this is, can be clickbait, but I just wanted to point it out because, people see this stuff and, they think, oh my God, it's the end of the world. So, it's saying here have soared in recent years, and it certainly has been a more of a sluggish market over the last couple of years because of the rates going up so fast the way they did. But over the last year, they've come down quite a bit. So, back on market, relistings jump as home sellers bet on a stronger spring market. Why? All these indicators we're talking about, lower rates are a big driver because it just makes it more affordable for people. Now, median age of the first-time home buyer falls to 35, according to Redfin and their data that's coming out. NAR put out a stat everybody was passing around the internet the last couple months, which basically said it was 40 years of age. But when you break that survey down and really look at it, most people aren't filling out 100 and 80 question questionnaire. And the percentage back was like in the threes, 3 point something percent. So that this is more in line with what we've been used to over the last few years. This 35, I would go with this one. And again, this is taken from different data sources, but Redfin's putting that out. That's hovering out there now. Realtor.com, Bankers Association, everybody's putting out this number. More homeowners now have mortgage rates above 6% than below 3%. And that's due to people just, basically having to move on or getting into the market for the first time. So more homeowners now have mortgage rates above 6% than below 3%. So that locked in effect, if you believe in that locked in effect, realistically, people move when they really need to. Yes, affordability does play a role for sure, but if someone has to move for work, for a family, life events, they just need a bigger home. They can't wait anymore. They're maybe waiting a year or two, maybe 3 years for rates to come down and things. They're just moving on. So people are jumping back into the market. Mortgage rates below 6% signal shift in housing market and save buyers a full monthly payment over the course of a year. Now, if you look at where rates have been over the last year and then where they are now, basically the average, for the average home, the average home buyer, the average price of a home, the average rate, if you take all that into consideration, people are saving realistically over $500 a month. So that's a big difference. Okay. And prices have pretty much held in most areas. Now, in the Northeast, there definitely is a lot less inventory. So that's something to keep in mind. I thought this was interesting because we hear a lot of talk about the rental market and corporations coming in buying up homes. First of all, it's Blackstone, not BlackRock, that's buying up single family homes, along with companies like Invitation Homes as another big one. There was a big article in the news about them recently, along with this, but with them having issues, with their renters and stuff. But if you break down the data, just to kind of summarize it really quick, and you look at, mom and pop landlords are by far the largest owner of single family rentals. In total, 89.6% of single family rentals are owned by landlords who hold between 1 and 5 properties. Okay, 1 in 5 properties, 89.6%. So, when you look at this and you break it down, even if you're looking at 6 to 10 properties, that's 3.5%. So these are, smaller mom and pop investors that have these properties, for the most part. If you break this down, when it comes to, let's say 50 to 100 properties, 0.8%. Okay, 0.8%, guys. So on single family homes, that's the story there. Um, Mortgage applications today, home loan demand increases for a third straight week, surging 11%, fueled by lower rates. Okay, that's out by Realtor.com. So again, that's a good forward-looking indicator for the next 30 to 90 days that pending sales should probably start going up heading into the busy season. Okay. We look at the jobs report broken down. Okay. When we break it down, the two things we want to watch. Okay. And let me go to the top here, actually. U.S. payrolls unexpectedly fell according to the BLS data as opposed to the ADP data, which usually there's more stock given to the BLS, although people, have their issues with the BLS too, and rightly so. But U.S. payrolls unexpectedly fell by 92,000 in February. Unemployment rates rises to 4.4%. Now, the unemployment rate, 4.4%, that definitely went up from that 4.3% we talked about earlier. So this just came out today. That Zillow report came out a few days ago. But 4.4% isn't necessarily enough to move the needle for the Fed, although they should start looking at this because, when we see these numbers dropping of payrolls compared to an estimate of for estimated 50,000, and below the downwardly revised January total of 126,000, it was the third time in 5 months that the economy lost jobs. And we're seeing a slow job start. Now, I tell people all the time, you can't have it both ways, and there was a meeting towards the end of last year that I brought up a few times that if you where all the economists go to, and long story short, the CEO of Redfin, or I'm sorry, chief marketing person of Redfin, basically explained that when she asked everybody that was there, over 90% of them felt that the higher Fed's fund rate was holding this whole thing up, which is part of their mandate and their demand destruction by keeping that Fed rate higher and being hawkish versus dovish and bringing this more in line with where we really are in the real time data of inflation, which is really closer to that 2% benchmark. If you look at Trueflation, we're under that 2% benchmark. We've been there for a while. And why? Because a third, if not 40% of that is made up of shelter costs. And then when you figure in how some of the management portfolios are figured into it, the Fed is really behind. The Fed is very much behind when it comes to the inflation rate. Finally, Jerome Powell admitted a couple months ago that, oh, we're catching up with the fact that shelter costs are coming down, but he's looking at rearview mirror data where we know the shelter costs, which is measured by owner's equivalent rent. It's a survey. It's an outdated way of doing it back from the 80s versus the real-time data that we get from these sources like, Zillow and CoreLogic and Cotality that show us that the shelter costs have come way down over the past 26 to 27 months. So they're still sticking to their story that they don't feel like the inflation rate has come down enough. But we can see that the jobs market has been hurting with job starts for a very long time. 4.4% unemployment's not enough to move the needle for them, but they are keeping that production down, hiring down, because most companies, especially larger companies, they need to borrow capital in order to go ahead and hire more people to pay or to build homes, for instance. And when we look at the two biggest indicators are construction and manufacturing, because if those are down long enough by enough, then that usually leads up to a recession. Okay. Manufacturing and construction jobs, especially residential construction. So we can see construction jobs again are down negative 11,000, and manufacturing, which has been taking a hit for, the last couple years, at negative 12,000. Okay. Now, some of that manufacturing, we may see some of that go up with things like, the CapEx boom that's coming, but that's going to take a while to get going. And some of that may be taken over by robotics, AI. So that's all in the mix. The other thing to show here is usually healthcare is usually an indicator that's up, and social assistance, that's way down too. So it shows that as many have pointed out, that the jobs market really isn't as strong as many want to point out, according to the numbers we're getting from the BLS. Okay. You don't believe it, you don't believe it, but that we can only go by the data we have. So again, many have made the case that the Fed should be at more of a neutral rate at their Fed's fund rate. They should have more of a hawkish tone, or I'm sorry, a more dovish tone, which would signal to the bond market. And then that would drive the 10-year treasury down, which would drive mortgage rates down. Okay, so sorry, allergies are killing me today. I'll try and battle through this. But 10-year treasury today ended up with everything going on, basically hovering right around where it's been. It ended up at 4.13, didn't make that 4.15. Okay. But we ended at 4.13. And for the last month, this is kind of where we've been at. So we'll keep an eye on that, but it was down just a hair from where we were in the last month and over the last day or so. So we'll keep an eye on that. The overall rates Right now, 30-year fixed, 6.14%. Now, if we look at our local mortgage broker, Andrew Fisher, Semperfi Home Loans, he's got rates. I didn't get an updated sheet this week, so this may be a little bit outdated, but I would say at the very worst, it's probably about 5.3 to 5.5 on a conventional. FHA, maybe a little bit higher than this, 4.9 to 5%. Same with VA. So there's that. And then if we look at, he's got these ARM programs, 5-year ARMs for conventional, FHA, and VA, and 4.75 for the 5-year ARM conventional, and 4.25 for FHA, VA 4.1. So definitely reach out to us so we can get you hooked up with those better rates than you're going to be seeing elsewhere. Okay. Even if you're out of state, reach out to us. And if you need an agent in another state, you can reach out to us too. We'd love to be able to refer you someone from our network and team to get you set up properly and help you maximize your affordability and your equity. So the Cromford report this week. Oh wait, before we get into that, I wanted to go over the data. So this is as of Monday, week over week from last week. 81 closed days on market. 4.4 month supply. Basically, with that 4.4 month supply, anything under a 4 month supply is a seller's market in general historically. When we look at the absorption rate, it's at 22.51%. That's holding steady from pretty much where we were last week. And it's showing us that the homes are definitely, being absorbed as far as sales are going. Average list price is 791,000. Average sales price is 659,000. And the list to sales price ratio is at 97.4%. Usually we like to see that at 97.8%. Active is down just a hair in the greater Phoenix area. Pending is down just a hair in the greater Phoenix area, and closed units is down just a hair at 0.8%. Closed units. The majority of these, when we look at the lower price points from 0 all the way up to 600,000, we see that we've actually got a little bit less inventory there in those ranges, but we're up in all the other categories from 600,000 on up, except for the 400 to 5 million, or I'm sorry, 4 million to $5 million range. And the whole market, it makes up 66%, 66.30% at 0 to 600,000. 600 to a million is 18.86%, and a million plus at 14.84%. Days on market active is up 14.1%. Days closed on market, 12.5%. Okay. When we look at year over year, just to kind of point out where we are this year as opposed to last year at the same time, we had new listings, 22,000, I'm sorry, 2,285 week over week. And if we look at the same week last year, we had 2,520. Okay. So a little bit less for the greater Phoenix area as far as new inventory coming on. But some of this, we may be still getting some data actually that would be coming out of the last week of last month. So this will be updated next week for you. The pending sales for properties that have gone under contract, 4,711. Okay, as opposed to last year at 4,212. So we're up. It means about 500 more buyers in the market going under contract than there were last year at this time. Okay, so definitely a big marker. Nothing crazy going on with the distressed market at all. Um, and if we look at the next slide, let me get out of this. This is our Cromford Market Index. So Cromford is basically telling us that our supply is just over the medium range where we want to be. So below 90 is a buyer's market. Above 110 is a seller's market. Right now we're at 83. So according to Cromford, we're in a buyer's market overall. Again, your area, certain areas of town, we're still seeing multiple offers on properties. If they present well, they're priced accordingly. Okay, not 2021 prices and 2021 hopium. Okay, but if they're priced properly, they present well, and they're marketed right, and properly positioned in the market, we're seeing definitely seeing multiple offers. So that's going to vary a little bit depending on all the factors and what part of town you're in, and even in parts of town, we're seeing certain communities having more activity than others, even in the same zip code. Demand um, is definitely lower than we want to see it right now. It's about 15 points lower than we want to see it. I think we're going to start seeing this snap back as more people are applying for home loans over the next 30 to 90 days, heading into the busy season. We'll just have to wait and see and just track the data as we go. Right now, we are at let me refresh this really quick for you. I don't know how that happened. Okay. So when we look at the week that the most up to date data we have here for what's active and what's under contract, we're basically right now at 36.4. Okay. Anything over 30 puts us in a warm market. So if we look at the heat map, this will kind of tell the tale of the specific areas. Tempe, we've got 35 active, 21 under contract. That is a hot area. That's in Tempe 85284. When we look at Phoenix 85028, that contract ratio is coming in just into the hot range now. Also, if we jump back down here to Phoenix, we're at 85045. That puts us at 71. Okay, anything over 60s in the hot range. So that's a super hot area right now. And then 85024 in the contract ratio is at 74. So again, above 60, between 60 and 80, that puts us in a hot range there. Phoenix 85053 is in a hot range. And also Tolleson at 85353 is in a hot range for the market. So definitely something that we want to keep an eye on, but we're seeing that these areas are heating up. Everything else, we're seeing less and less cold areas, although like right in the middle of town, right there is pretty cold. There's a couple of warm areas, but it's pretty cold there. Everything else is kind of in a balance to warm feel on the outskirts of town. So again, something to keep an eye on. We'll definitely keep an eye on that. I wanted to point out one of our listings. This property here is listed at 785,000 at 9782 West Buckhorn Trail. It's a 4 bed, 3 bath, 2,872 square foot on a quarter-acre lot with a pool. It's got own solar, mountain view, as you can see there. It's been updated with fresh paint, new hot water heater. Okay, and it's got a 3 car garage with an RV gate, RV parking. Um, and just to give you a quick look here with our video we just ran. You see, there's nobody behind you there. You kind of back up to a cul-de-sac and there's nobody directly behind you there. You can see that RV gate, three-car garage. Great property. It's got a Jack and Jill bedroom setup, split floor plan, private pool. It's got some updated lighting. So guys, if you have any questions at all, feel free to reach out. We'd love to be able to help you with your real estate needs. If you have questions about getting qualified for a home loan, or if you have, getting those lower rates that we talked about, if you have questions about what your equity is, you're just kind of thinking about kicking it around, maybe selling this year, next year. Best thing to do is just have us come out. Again, no pressure, no obligation at all. We will give you an assessment on the updates you've done, do a walkthrough of the property, take about 10 minutes, and give you an idea on, with the updates you've done in the current condition, what it would value for right now, give you a net sheet breakdown, what it would look like to sell that property today, leave you with some the active properties for sale, properties that are under contract, which kind of tells us more of that contract ratio, and what your competition is and has been, and where the market's heading, and also the properties that have actually closed that have been appraised in your area, so that we can give you kind of a full picture of what that would look like to get your property sold today, and anything else that we can do as far as staging, design, ideas to get your property ready to present for sale so that it sells quickly for top dollar. We'd be more than happy to come out, take a look at that. Even if we do that, you're not ready to sell yet, that's fine. We can keep you updated, on your property's progress as far as, moving forward, as far as the prices in the area, keep you updated on market reports for your particular neighborhood and area. And, then if you do any additional updates, we can update the value from there. So guys, feel free to reach out anytime and we'd love to be able to help you out. Thank you so much. Have a great weekend.